Hey, I'm Jonathan Wild, and we are going to cover how to record cash dividends. So let's say the corporation has a good year, and the board of directors, who are kind of like in charge of overseeing the corporation, decide to pay a cash dividend to the owners, which is a distribution of cash to stockholders. In accounting for cash dividends, there are three important dates. The first is the date of declaration. This is the date the directors vote to declare and pay a cash dividend. And this creates a legal liability of the corporation to its shareholders. For example, assume on January 21st, the board declares a $2 per share cash dividend, and there are 40,000 outstanding shares. We record this with a debit to retained earnings for $80,000 and a credit to common dividend payable for $80,000. Retained earnings is an equity account used by corporations that includes cumulative net income minus any dividends. We debit retained earnings to reduce equity. We credit common dividend payable to increase liabilities because we now owe stockholders that dividend. After that comes the date of record. In our example, that is February 4th. Anybody who owns stock on the date of record will receive a dividend. We don't make a journal entry on the date of record because we are just determining who will receive a dividend. Now last, the date of payment is the date when the corporation makes the dividend payment. So let's assume February 13th is the date of payment for the $80,000 dividend. We record this with a debit to common dividend payable for $80,000 to remove the liability because we have now paid the dividend. Also, we credit cash for $80,000 to recognize the decrease in cash.